Understanding liquidity events, key concepts and implications. A liquidity event represents a critical juncture in the life of a company, marking the transition of founding teams and early investors from holding illiquid assets to cashing out their equity. This is typically achieved through mechanisms such as mergers, acquisitions, or a public offering of shares, IPO. What is a liquidity event? A liquidity event is defined as an occurrence that enables founders, early investors, and employees of a company to convert their ownership stakes into cash. It serves as an exit strategy for investment in businesses that might have low liquidity, meaning their equity isn't easily traded or sold on the open market. Why liquidity events matter? Liquidity events are essential for several reasons. Investor expectations. Venture capitalists, VCs, angel investors, and private equity firms invest with the anticipation of liquidity events occurring within a defined time frame. These events represent the return of capital plus potential profits, vital for the continuing operation of funds and the valuation of their own portfolio companies. Founder motivation. While investors typically rush toward liquidity events, the perspective of founders can vary. Some founders may view a liquidity event as a means to fund personal projects or future investments, while others may be apprehensive about the dilution of ownership or loss of control. Types of liquidity events. Liquidity events primarily occur in two forms. 1. Initial public offerings. IPOs. Companies offer shares to the public, providing them with the necessary capital while allowing early investors and employees to sell their shares in a public market. 2. Acquisitions or mergers. A company may be bought by another entity, leading to cash payouts for the original founders and investors. Participants in liquidity events. Founders and employees. Founders usually retain a significant equity stake in their company's post-event, but they must define their commitment levels if they choose to stay post-acquisition. Early employees often benefit significantly, provided their compensation packages include stock options. Investors, venture capitalists and other investors look forward to liquidity events as pathways to achieve returns on their investments. The success of a liquidity event can significantly impact the reputation and future bidding power of such firms in the investment landscape. The role of founders. The motivations of founders during liquidity events can differ significantly from those of their investors. While VCs may be eager to catalyze an exit strategy, some founders may experience reluctance at the thought of going public. They often fear losing decision-making power and diminishing the vision that initially drove the company's growth. For instance, Mark Zuckerberg and other stakeholders of Facebook experienced a successful liquidity event during their IPO in 2012, raising $16 billion and establishing a market valuation of $107 billion. Despite initial fears of control dilution, the event ultimately positioned Zuckerberg and co-founders with substantial wealth and influence in the tech industry. Control and timing of IPOs. Companies seeking to go public have a significant degree of control over when they bond with public markets. However, certain regulatory requirements detailed by the Securities and Exchange Commission, SEC, must be met, particularly for firms with assets exceeding $10 million and significant numbers of non-accredited investors. Current market trends in IPOs. In 2023 alone, the U.S. saw 153 IPO deals that generated roughly $22.7 billion in capital. This figure highlights both the vibrancy of the market for public offerings and serves as a barometer of investor confidence in the U.S. economic landscape. The nature of venture capitalists. A typical venture capitalist is defined as a private equity investor looking to support companies with high growth potential in exchange for equity stakes. Funding can vary from early-stage investments to providing capital for expansion. Conclusion. In conclusion, liquidity events are transformative experiences for companies and their stakeholders. They allow founders and investors to unlock the equity tied up in their businesses, facilitating reinvestment and personal financial growth. While these events often carry investor enthusiasm, the perspectives and strategies of company founders may greatly vary, highlighting a complex interplay of interests within the entrepreneurial ecosystem. Understanding the dynamics of liquidity events is crucial for stakeholders aiming to navigate the investment landscape effectively. This article aims to provide a comprehensive overview of liquidity events and answer common questions related to their implications and importance in the business world today.